start right in.
Yep.
Get right to it. Welcome. You're listening to Mortgage Investing 101, the show where we discuss high yield real estate mortgage backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co host, Mark Hanf, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields using your savings or IRA accounts. Annual yields of 8% and more are not uncommon using these strategies that we're going to discuss in today's show. And if you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. And you can also check out our website at mortgageinvesting.com, mortgageinvesting101.com.
That's right.
That's right. You can also call our hotline 888-529-1134 and leave your name and question, and we'll get back to you after the show. For fun, we're also going to have trivia contests where at commercial breaks, where the first three callers with the correct answer win a free 3-day, 2-night vacation. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. The vacations are free. Lighthouse is only requesting a $75 cleaning fee. Check them out at lighthouse4fun.com. Today's trivia theme is the number 100. You'll understand when we get into it. Okay, now Mark, we've been on for just about 3 months. This is our 12th show.
That's right, our 12th show of Mortgage Investing 101.
Yeah, we're getting a lot of good feedback, good emails, questions during the show, after the show. Why is that?
Well, I think the answer is obvious. People are starving for yield right now. I mean, look how long we've been living in a near zero interest rate environment where,
Well, I don't even say zero. I'm at 0.00001% on my savings.
Rounding error. That's
yeah,
what, that's
yeah,
what
exactly.
that is.
That's what it is.
So, look, a lot of people lost quite a bit of money when the market turned in 2007, especially if you were heavy in real estate, as you and I both were,
Yep.
Number one. And even the stock market. I mean, we were all joking about, no joke really, about how, our 401ks were now 201ks, and there's been a lot of talk about the lost decade in the stock market, that we're just now kind of getting back adjusted for inflation
Sure.
of any kind of return over
Yeah.
the last 10 years, unless you were in individual stocks that did well, if you were in Apple or if you were in Google.
You
or
just
other
happen to pick
stocks.
the right one.
Right, if you happen to pick the
But
right
most
stocks.
people are just in generic
Right,
mutual
most
funds
people,
or-
right, are in funds, right? That's exactly right. So we've got a situation here where most people are no longer on track to retire successfully, thanks to, or no thanks to, the fact that yields over the last 10 years have been really difficult to obtain. It's been really hard to grow a retirement portfolio over the past 10 years if you were relying on mutual funds or bonds or other conservative over-the-counter types of traditional investments. And certainly if you have cash and money market accounts and CDs, I mean, your money hasn't been doing anything for a long time. So, all this time during this period, there have been a small subset of investors that have kind of known about this, little-known alternative investment strategy known as mortgage investing, and that's what we're going to talk about today. And mortgage investing is also called private lending, and it is a way that you can invest your money or loan your money with safety and security features that are surprisingly strong. In fact, in my opinion, stronger than the stock market. And you can achieve returns of 8, 9, even 10% in some cases. But just forgetting about the 9 and 10, just 8% all by itself is a fabulous return that people over the last 10 years, year in and year out, have achieved these types of secured returns through what's known as mortgage investing.
Okay, give us an example, because the listeners are hearing 8% and suddenly their ears perk up, saying, okay, wait a minute, how am I going to get 8% and have it relatively secure?
Right. So it's called private lending because basically you are using your funds to fund real estate secured loans. So you're being the bank. That's another way to look at it. So when Wells Fargo or B of A makes a real estate loan, they secure it with a recorded mortgage, or in California we call it a deed of trust. The borrower signs a promissory note. They usually make it for a percentage of the purchase price or a percentage of the value. They normally don't do 100% financing anymore. In fact, banks are famous for 80% loans. That's pretty common.
Yep.
And the banks make a lot of money doing that. That's how banks make their money, is by loaning it out. So in the private money lending realm, it's virtually identical to the banking model, and that is, we at our company, Pacific Private Money, we specialize in making loans to real estate investors. We're making loans that the banks are no longer making since 2008. So it's a niche lending market, but it's a strong lending market,
Well,
number one. And then number two, we're only making generally 70% loans. We're not even doing the 80% loans. So in this case, the private individuals who make their money available to us to loan out are receiving the same safety and security features that Bank of America or Wells Fargo receives when they make a loan. That's why it is secured. It's secured by a promissory note, which is a contract promise to pay at a specific rate. And our loans are not inexpensive. We don't lend at the bank rates. We lend at 8, 9, 10% interest rates to the borrower.
Well, let me go back for a minute. So I'm the audience listening in, and I'm thinking, well, this sounds a little complicated, and how sophisticated do I have to be? I mean, how do I go out and try and find these loans?
Well, and it does sound complicated, and it does take a little while to explain to someone who's unfamiliar with this whole area of mortgage investing, how it works and why it works and why it's secure. In fact, I spend most of my time every day talking to folks who, in fact, are listeners to the show, who call and say, I want to know more about mortgage investing and how I can make 8% or more of my money.
Which, by the way, we're going to give not a break, but we're going to let people know you're listening to Mortgage Investing 101 with Edward Brown and Mark Hanf of Pacific Private Money. And Mark's phone number is 415-883-2150, and his website is pacificprivatemoney.com. Okay, go ahead. Continue.
Absolutely. So it isn't complicated. In fact, it's one of the simplest investment opportunities out there, in my opinion. I mean, once you understand it, it doesn't really take that long. It's more of a kind of a conversation. People will ask their questions about how this works or how that works. But it's really a very simple way. And the way a person invests is they really have to work through a licensed mortgage loan originator who specializes in privately funded loans, again, mostly to real estate investors, because the old hard money loans that used to be made, which used to be seconds to people who are in distress, is that market's kind of gone by the wayside. It's been kind of regulated out of business. And nowadays, in the last 5 years, this new banking environment has created a number of companies like Pacific Private Money. We were formed in 2008 and have made 600 loans since 2008 to real estate investors, and all of those loans have been funded with private individual capital. And so I have networked for years to develop a database of individuals who either were already familiar with private lending and had done it before, or quickly were able to understand through one or more conversations with me as to how it works, and where they'll satisfy themselves that there is the safety and security features that they would be, of course, very interested in, because it's their life savings.
Okay, so again, I'm the audience listening in, and I'm hearing that I can earn 8% on my money, and the first thing I'm kind of thinking along these lines when I hear about real estate investors, et cetera, if these loans are so secure and so safe, why aren't these borrowers just going to a bank and borrowing at 5% interest?
Well, like I said earlier, the banks stopped making certain types of loans after 2008. They're no longer making what they call subprime loans, which were oftentimes loans to distressed borrowers. And they also pulled out, and this is again not known by a lot of people, unless you're a real estate investor yourself, you wouldn't know that the banks really aren't making loans to real estate investors today anymore. And the reason why they're not is because what was happening in 2005 and 6?
Oh.
Everybody who had a decent FICO score was buying up rental properties, right?
Yeah.
I mean, people were, taxi cab drivers were owning 3,
Sure.
4, 5, 6, 10 properties.
Well, and the banks were lending like 95%.
Right. So no money down and stated income and liar loans, as they called it. So all of these non-owner occupied properties were financed by the banks with at or near 100% financing, and the banks, of course, took a bath, and they're still working through some of that inventory right now. I mean, foreclosures are way down, but they're not. There's still millions of homes underwater, and a lot of them are non-owner occupied investment properties. So The banks stopped after 2008 making loans to real estate investors.
Okay, we're going to cut to a commercial break. And again, you're listening to Mortgage Investing 101 with Edward Brown and Mark Hanf of Pacific Private Money. Mark can be reached at 415-883-2150, and his website is pacificprivatemoney.com, and our website for the show is mortgageinvesting101.com. Don't forget to put my picture up there. Okay, and we're going to cut to
I'll get the web guy on it right away.
Oh, there you go. Okay, and when we come back after commercial break, I want to ask Mark about how the government shutdown has affected your business. Okay, here's our first commercial break, first trivia question. And again, the theme is the number 100. What was the name of the Roman soldier who was in charge of a 100-man unit? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What was the name of the Roman soldier who was in charge of a 100-man unit? 888-529-1134. Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time. Don't touch that dial, because when Mortgage Investing 101 comes back, Mark Hanf will explain more how you can earn 8% or more on your money.
Okay, awesome.
Yeah.
Okay. Was that like 14 minutes?
No, that was only 11:25.
Okay.
I just want to give a little teaser there, because I want to consistently remind people the phone number and the website.
Of course, no, absolutely. And before we get into the continuation, let's talk about the event.
Oh yes,
Let's
I
invite
forgot
people
about
to the
that.
event.
Okay, that is correct.
James should have the podcasts up on the website today or tomorrow. So
And I did send them to you all of them, I think, right?
Yes.
Okay.
And I sent him your suggestions on changing that. So I told him I'd pay him, so he's ridiculously inexpensive. He said,
Yes.
it'll be a few hours work, but how about $85? It's like,
Yeah.
He could have said $185 and it would have gone fine.
And has he given you like enough information so that when you want to change things, you can do it on your own?
Yeah, I could.
Oh, okay,
I can, but I'm happy to use him
Okay.
if he doesn't mind.
No, I don't think he enjoys the money.
Yeah.
Yeah, it takes me a long time to edit the videos because of having to constantly put in the annotations. Mark Hanf, Pacific Private Money, co-host, that sort of thing. And I haven't even done it on the mortgage show yet. Okay. So we'll get into the event.
Okay.
Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money. He's the president. And the name of the show is called Mortgage Investing 101, and Mark's company is called Pacific Private Money, where you can reach him at 415-883-2150 to earn 8% or more on your IRA or savings account, relatively secure. Okay, so the first commercial break, first trivia question. What was the name of the Roman soldier who was in charge of a 100-man unit?
Well, the audience doesn't know this, but you don't give me the answers to these questions.
I don't.
Before. I didn't know that was the definition, but I'm guessing it's centurion.
That is correct, and that's, I guess, cent.
Makes sense.
Makes
Centurion,
sense.
yeah,
That's right.
makes sense.
So before we get into the question, I was going to ask you about government shutdown and how that's either helped or hurt your business. You have an event coming up.
We do. We have what we're calling our fund launch event, which is for people to learn about more about our mortgage pool fund, which we started earlier this year, and we've already got 18 investors and just under $2 million in capital, which has already all been put to work over. I think we just funded our 12th loan in the fund.
What are you earning?
We paid out our third quarter distribution to the shareholders, and it was at an annualized rate of 8.9%, which is actually higher than our target. Our target's about 8.5% from the mortgage pool fund. But anyway, we're having our fund launch event on Wednesday, November 6th at the Piatti Restaurant in Mill Valley, and it's in the evening. We're going to have it from 6 to 8 p.m. at the Piatti Restaurant in Mill Valley, and if you are interested in attending that event and learning more about our mortgage pool fund. We're also going to have a special guest there from IRA Services to talk about self-directed IRAs, which many people use to invest in mortgage pool funds or individual trust deeds. And so you can call our office and we'll add you to the RSVP list.
And it was $100 a head?
It's
Charging?
free.
Free?
You know,
That's my favorite price.
We're having great food because Piatti's is a great restaurant in Mill Valley. It's a beautiful room. We have enough room in there for 100 people, and so far we've got about 70 RSVPs. And there's always a little bit of attrition. So people don't show. We do expect it to be full, but we're going to have great appetizers and beer and wine as well.
Excellent.
It's going to be a great little event. We're going to do a kind of a high-level presentation for the audience about the fund. We'll talk about self-directed IRAs. You can meet people from IRA Services and ask questions about how you might be able to convert your existing IRA into one that you can self-direct and invest in things that produce higher yields than the stuff you're suffering through right now in your 401k. So call us at 415-883-2150 and tell Jordan, the lovely voice that'll answer the phone, that you'd like to put your name down in RSVP for our fund launch event.
Free food, free beer and wine. Love that.
Yeah, don't just come for that, but
that's why I'm coming. No. Actually, no, you'll get to meet both Mark and me, and actually Mark's staff there too. So it ought to be fun. Okay, so now let me ask you: the government shutdown, as of today, I think it's still shut down. Has that hurt your business or helped your business, or no effect?
Great question. It's actually helped. We have gotten several panicked loan requests from borrowers who believed they had conventional financing lined up, only to find that the government shutdown has stalled their ability to close.
Why would that, like if I'm going to be refinancing or buying a home and Wells Fargo, let's say, is my bank, what does that have to do with the federal government?
Well, we got 2 applications this week, and both of them were for the same reason. When you get a bank loan, very often they will want to confirm, you'll provide them with your tax returns and W-2s and all the stuff that you normally provide them with. And then they generally want you to submit a form, and that form happens to be called a 4506T. And that form is something that is an IRS form, and it's one page, you fill it out, you sign it, and they send that to the IRS or actually fax it, and what they get back is a certified copy of your tax return. So
like a transcript.
It's a transcript, right? So at least so anyway, the transcripts have been that whole department's been shut down and closed for the last 2 weeks.
So Wells Fargo can't really verify that when I tell them I make $10 million a year on my W-2 or on my tax return. They can't verify it.
Right. So there's been a number of stalled transactions as a result of the government shutdown, and not just from the transcripts, but there are other government-related and FHA-related issues that have caused delays. And if you as a borrower are unable to get an extension, and maybe you're already on your second or even third extension, and the seller's basically saying, perform or I'm going to keep your deposit. So that's been a situation that we have been able to help the client. And again, we don't normally pursue these types of transactions. I mean, generally speaking, we're making loans to real estate investors who are buying, fixing, and flipping real estate. They don't mind paying our points and fees because they have a profit incentive. They know they're going to make money on these deals. In the other 2 situations we just talked about, these were consumers looking to buy a primary residence, and they certainly don't want to pay 10% 3 points, but if it's a matter of losing the opportunity to buy a home in a market that's very tight right now, oftentimes it's an option to them, and we're not pushing it, but
eventually when the government gets unshut down, they'll be able to verify with the tax return with the government and get a bank loan.
Yep.
But do you put any kind of minimum interest guarantee?
We normally do. It depends. If the mortgage pool fund makes the loan, we can do a no prepayment penalty loan, meaning that if they want to pay it back as quick as possible with either by selling the property or using conventional financing, they can pay it back in 60 or 90 days. If it's an individually funded note, which is a private loan or a trustee investment made by an individual lender, then oftentimes we have a minimum interest, and 90 days is typically the minimum, but oftentimes we're writing loans with a 6-month minimum interest. It depends on how long the borrower believes he'll need the money, and then we ask that what's the longest you feel comfortable with guaranteeing in terms of a minimum interest to the lender? And the reason we ask for that is because one of the nuances of private lending is that oftentimes these are short-term loans. In fact, more often than not, the loans that we're making are short-term. And as a private individual lender, many of my private lenders don't want to go through the process of deciding to fund an individual loan only to get paid back in 60 days.
Sure.
It's
But I like the short-term aspect because, one, you don't know how the economy is going to do, and also if interest rates go up, I wouldn't want to be locked into a low interest rate as an investor. But getting back to your fund for a minute,
Yeah.
give us, because you said you have 18 investors in the various, in the fund, which has $2 million in it.
right. We started the fund. We launched it in the spring.
And it's earning net to the investor after fees, whatever, of 8.9% so far.
So far, our target yield to the investor is 8.5% on an annualized.
Okay,
basis.
so you're over, you're
For the third quarter,
the
we're
third
up.
quarter you're over. Okay, what kind of loans? Can you give us an example of some of the loans that are in the fund?
Well, the average loan size, we're putting what we would consider relatively small loans in there. Small for us is between $100,000 and maybe $300,000 or $400,000. That's on the small side. So we do make loans between $500,000 and $1 million, and then we've got certain loans we make that are between $1 million and $2 million. Those are normally funded by private individuals or small companies who are in the business of private lending and enjoying the yields they make by funding loans that size, oftentimes at 10%, for example. But the fund, we're looking to diversify over a wide spectrum of loans. As the fund grows larger, we will start to make, from time to time, larger and larger loans. But right now, we're focusing on, in fact, the smallest loan in the fund is $50,000. And it's actually not a $50,000 loan. It's $50,000 of a $250,000 loan. So the fund took a fractional interest in a $250,000 loan to a real estate investor who was buying, fixing, and flipping a property in Santa Cruz. So the types of loans that are in there is, I believe, all but one are residential properties. We call them single-family residential 1 through 4, which means 1 unit through 4 units. Anything up to 4 units is considered residential
Okay, so
property.
so they're not commercial buildings or apartments.
One is a small commercial building, about a 5,000 square foot commercial building in the Bay Area, and we're looking at putting another loan in the fund in the next couple of months. That would be a building that houses a Starbucks building in a very nice area of San Jose that will be about a 50% loan to value, but that's down the road. But so the typical loan in the fund is no larger than 70% loan to value, oftentimes less, and on residential property, generally short-term loans made to people who are acquiring property at a price they believe to be very compelling, sometimes by short sale, sometimes directly from the bank, and they're adding value by remodeling the home with the intent to put it on the market in the coming months. And those loans are typically paid off in as little as 90 days, as much as 12 months, with the average payoff being around 8 months. 6 to 8 months is the typical time to buy, fix, and flip.
Now, how do you make your money, and how does the fund make its money? Because I'm thinking of there's interest and there's points.
Right. So the fund, the way we designed this particular mortgage pool fund is because we knew that the majority of our deal flow is short-term loans to people who are buying, fixing, and flipping. We knew that if we just designed a fund that only earned the interest rate on the note, that it was going to underperform. And we didn't want to have a fund that underperforms. We wanted to have a fund that provides what we think is a very compelling year after year yield to the shareholders. So we designed the fund where we're putting in not only 100% of the note rate, so if the note rate's 10 or 10.5 or 11%, the fund earns all of that note rate, but we're also putting in 50% of the origination points. And so on any typical loan, we're usually charging on average 3 points to the borrower or 3% as a origination fee.
So half of that, 1.5% goes into the fund.
Right, so half of the origination points go into the fund. We call that the house share of the points. And why we call it the house share is because the other half are used to pay our sales staff. So our sales staff are commission only. They take calls off the floor. They take calls from the referring brokers, and they underwrite and do a lot of the legwork on a loan in advance of us deciding whether or not we like the loan enough to fund it.
Okay, so I'm not too stupid here. I've got an IQ in the 3 digits, and I'm thinking then if you do short-term loans, because you're charging points and you get to roll the money over frequently, that's going to give the fund a higher yield than normal.
Right. So the nature of a mortgage pool fund is there are expenses. We have a fund administrator that handles all of the paperwork and the shareholder communications, etc. And they charge a certain percentage. And then the fund manager, which is Pacific Private Money, gets a fee for managing the fund. There's an annual audit that is not inexpensive that gets paid by the fund. So the fund needs to earn double digits in order to produce a strong, between 8 and 9% yield to the shareholder, which again is our target. And the fund has many things, many advantages over an individual note, which we can talk about maybe in the next segment.
Which we're going to cut to another break, and we want to remind people you're listening to Mortgage Investing 101 with Edward Brown and Mark Hanf of Pacific Private Money, and Mark can be reached at 415-883-2150. We have 2 websites. PacificPrivateMoney.com is Mark's direct company's website, and the show has its own website, www.mortgageinvesting101.com.
Right, and we just, I think this week we uploaded previous shows. There should be 8 to 10 podcasts available on the Mortgage Investing 101 website. So if you came in late on the show or just catching a snippet of this show, Mortgage Investing 101, do go to mortgageinvesting101.com, of course, all one word, and click on the previous podcasts and listen to one of the shows there.
Excellent.
And tell a friend.
And like us. Oh, wait, is there a Facebook page? Not yet, or is that, you can go to Pacific Private Money and...
Pacific Private Money does have a Facebook page.
Okay, so you go to that one. All right. That's very important for people to like you. Okay, second commercial break, second trivia question. Again, the theme is the number 100. Which fictional character lived in the 100-acre wood? The first 3 callers with the correct answer win a free. This is a children's
I can name
episode. Well, this is the main character.
All
yes.
right.
The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. This is a family show. Call 888-529-1134. That's 888-529-1134 to answer this question. Which fictional character, and we'd like the main one, please, lived in the 100-acre wood? Which, by the way, until I had kids, I did not know this. I mean, I lived in a cave. No, I had no idea. I didn't even know any of this stuff. Okay, call 888-529-1134. Make sure to include your name, your email address. Please speak slowly. Spell out your email one letter at a time. Don't touch that dial, because when we come back, Mortgage Investing 101, Mark Hanf will go into the deal of the week and let us all know what kind of deals he's working on.
Probably go just a minute there, real quick. I didn't talk about the 2 ways to participate in mortgage investing. One is funding an individual note. The other one is through the mortgage pool fund.
Okay. So when I upload when I give these to you, you edit them however you want, right?
Well, so far I've been taking the actual show itself with the intro music. Yeah, that's really the best way to do the podcast thing. So if you
that's not the video. That's
right,
just
when you get back the show from the radio station, then
that's when you do. Okay.
That's when I upload it to my Box.net account. And then
So giving you the video, is that do anything for you?
I haven't done anything with the videos because Marcus is backlogged working on some other stuff for me.
Well, I'll still send them to you anyway.
Yeah. Calculate. Lisa knows I'm recording and she's asking me to call her. So really?
It's important. I've got 18 minutes.
Nice. Yeah. So let's not get into deal week right away. Let's just talk about first off the. Let's talk about.
Oh, invest in different investments.
Yeah, just the different investments we haven't had a chance.
Yeah, I was saying, so how do people invest? Right?
Yep.
Oh. Wait a minute, I got lucky. Is that what you call it? Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. And again, on this show, Mark is teaching us how to earn 8% or more, which actually his fund just produced 8.9% on conservative real estate mortgage investing.
Indeed.
Okay, the theme, the trivia theme of this week was the number 100, and here was the second commercial question, trivia question. Which fictional character, the main one, lived in the 100-acre wood?
That'd be Winnie the Pooh.
Winnie the Pooh. That's right.
Tigger.
And Tigger.
Piglet.
And Piglet. And
Eeyore.
Owl. And Eeyore. No, it'll never work. I just know it. Okay. Mark, so far you've been teaching us about investing in mortgage investments, earning over 8%. How do people do it? I mean, what's the next step?
Well, what we didn't get a chance to get into in the last two segments were there's actually two ways primarily to participate in mortgage investing and earn those high yields that are secured by real estate. One way is to invest in an individual note, which has probably been one of the more common ways since 2008 to participate in mortgage investing. That particular type of individual note investment is often called trust deed investing because your money is secured by not only the contract promissory note but a recorded deed of trust or trust deed on that property. The second way is through a mortgage pool fund, and we talked in the last segment about our new mortgage pool fund called the Pacific Private Money Fund, and we talked a little bit about our fund launch event that we have upcoming on November 6th in Mill Valley. And so the mortgage pool fund and individual notes are different ways to participate in mortgage investing, and some clients prefer one versus the other, and they both have their strengths and their disadvantages over the other. So, for example, investing in an individual note is where you look at a specific loan request that we have underwritten, and you decide whether you like that property and or borrower enough that you would want to fund all or a portion of that loan. So let's take, for example, a $200,000 purchase loan to buy a $300,000 property in Oakland for the purpose of remodeling it and flipping it over the next 6 to 8 months. So you look at that property and you think, well, that's not a bad area, and you look at the borrower's profile, credit, experience, background check, all the things that we do when we underwrite a loan.
It sounds like you do the same thing a bank does.
We do very thorough underwriting on both the borrower and the property, just like a bank. So you look at that individual note and you make a decision as to whether you want to fund that loan. And maybe you have $100,000, you want to maybe invest $100 on the $200, or maybe you have all the $200, you want to take the entire note. Now, the reason that a lot of my clients like doing individual notes is because you know where you're lending your money. You're making the decision to make a loan to that borrower secured by that specific property. You can get in your car, drive by the property, you get to look at all of the underlying application information like the loan application itself, which we call the 1003. You can look at the credit report, you look at all this stuff. And generally speaking, you're going to get a slightly higher return on an individual note than you will on a mortgage pool fund. Although, depending on how fast you get paid back, maybe not so much. I mean, if your money sits in cash for 30 or 60 days out of a year because you're going into these you're investing in these individual short-term loans.
Gets diluted.
It gets diluted a little bit. So there is a little bit of of an illusion to say getting 10% on maybe on a loan versus the 8 to 9% you get in a mortgage pool fund. So those are the reasons why some people like it, is because the ability to choose the property, the borrower, get a slightly higher rate, You're in control. Now, the downside of it is that there's a lot of competition right now. I mean, I'll get a loan request, we'll underwrite it. This is a good loan. This is a Pacific Private Money quality loan that we like to do, and I'll send it out by email maybe to 20 or 30 or 50 people, and all of a sudden the phone will start ringing like crazy, and only one or two people are going to get that loan, depending on whether they take the whole thing or fractionalize it, or maybe one person will say, I'll take the whole thing, and it'll be gone sometimes in 5 minutes. I mean, I have so many clients who have money to place, and so for the more passive investor, and so if you're a listener to the show and you've not participated in this type of investment strategy before, or maybe not recently, it's very competitive. So it's hard as an individual to get in on the best loans. Whereas now that we're started our mortgage pool fund at Pacific Private Money, my promise to the shareholders is that the fund, when it has capital in it, will always get first look at every deal that we're underwriting. So the best loans are going to go into the fund first. So
Good
that's
deal.
so go ahead.
Yeah, well, I was going to. I'm a very risk averse person. So, tell me about the risk. Okay, so let's say there's in your example, a $300,000 house. The person's putting $100,000 down. They need a $200,000 first mortgage. So that's 67% loan to value. Yeah, fairly conservative. I mean, I guess the risks are that the borrower doesn't pay.
The risks are the borrower doesn't pay, and the reason why we do not lend as high a percentage as the banks do is, quite frankly, because we think that because these are, real estate investors, that we need to be more conservative. The loans are being funded by private individual capital. This is life savings money that we're talking about, and so we do not want to be aggressive lenders with that money. We have a fiduciary responsibility first to our lenders. In fact, when I first got into this business, after being 25 years as a real estate investor, and now all of a sudden I'm looking at being a lender, one of my mentors in the business said, what most people don't understand who come into private lending as a business model is that we're in the investment business first and the lending business second. What does that mean? Well, what it means is that I'm creating investment opportunities for people to use their savings to earn higher yields. That's my primary business. Secondarily, we also happen to be a lender. We're making loans, secured real estate loans in the Bay Area. So our vision for the type of loans we do is we have lending parameters, we have lending guidelines. We turn down 9 out of 10 loan requests on average.
Well, from the bank, the typical bank, they have loan loss reserves that the taxpayers will pay for.
We don't like thinking in those terms. Of the 600 loans we've done at Pacific Private Money, less than a dozen have had to have notices of default filed, and only 5 actually went to foreclosure. In all 5 of those cases, the lender who made the loan, who ended up owning that property, was better off.
Had a very big smile on his face.
Right, because they now own property that was worth more than the underlying loan. And what would happen that would cause someone to stumble and lose that property? Well, things happen in life.
Divorce.
Sometimes it's an event in their life that was unexpected, and now all of a sudden they don't have the cash flow to make the loan payments. Maybe they had a contractor that didn't do the work correctly, and now all of a sudden they're over budget. They don't have the ability to finish, and the project basically stalls.
Well, it sounds like when you make a loan, you're looking at the property as though you would almost like to own it for that price.
Well, you have to look at it that way. I mean, the private lending really works best when we look at that property and go, would we mind owning that? And so,
and not only, but I mean, owning it for less because you're not lending 100% loan to value, which reminds me again, we got to tell people the name of the show is called Mortgage Investing 101 on KNEW 960 AM. You're listening right now to Mark Hanf and Edward Brown. Mark can be reached at 415-883-2150, and our hotline is 888-529-1134 to leave messages. Mark's company, Pacific Private Money, they're located in Novato. They have a storefront there. You can always go visit them at 1604 Grant Avenue in Novato. And remind people again about the event that's coming up so that they can kind of, put a face to the voice.
We're having a fund launch event to talk about the Pacific Private Money Fund. It's a mortgage pool fund that was launched at the beginning of 2013, and we're already up and running. We've had a successful third quarter with the results that just came out last week, and we made our distributions, paid 8.9% on an annualized basis to our charter fund shareholders. And so the event we're having is going to be in Mill Valley at the Piatti Restaurant on Wednesday, November 6th at 6 p.m. And we're going to have a short presentation. It'll be mostly having a good time and meeting people and talking one-on-one, but we also will have a short PowerPoint presentation with high-level overview of how the fund works.
And it's a free event with
free
good
event.
food.
Yeah, it's a free event with good food. Edward, the one point I wasn't able to finish on that we started this segment with was talking about some of the, comparing and contrasting the two ways to invest in mortgage, to make mortgage investments. One is through funding an individual note. The second is through a mortgage pool fund. And I didn't get a chance to talk about the benefits of the mortgage pool fund side of things. So on a mortgage pool fund, one of the reasons that people like that as the investment opportunity is because now you're not competing with other people for a loan and having your money sit in cash. You don't have to get in your car and go drive the property. You don't have to make those decisions because the fund manager, our team, our loan committee, we underwrite and then make the assessment on whether a loan request is a go or no go. And so when you're a shareholder, your money goes to work right away. You don't have to wait for the right opportunity, which you might not even get because someone might beat that out to you. Your money is, your risk is spread over the entire portfolio of loans in the fund. So you're not making a loan to an individual on an individual property that may go south, and if it does, now you're having to put the money up to file foreclosure. Whereas in a mortgage pool, if we have a loan that goes bad in the pool, we take care of it as the fund managers, and the fund pays for the fees for the foreclosure.
Well, so it's a lot easier for someone to invest in the fund.
It's way easier, and now I do need to say, because I sometimes forget to remind people, the fund is open to accredited investors only, and that's defined as you have a $1 million net worth, not including your personal residence, or you make more than $200,000 a year for the last 2 years. That's a Securities and Exchange Commission. It's a government definition. It's not our rule, it's the government's rule. We're not allowed to accept investors into our fund who are not accredited investors. So
you can combine husband and wife's incomes out.
You can, yes.
Okay.
And well, it's 300 if it's combined husband and wife. Same name. Anyway, call me for more information on that. Didn't want to get off on a tangent on accredited investors, but do realize that is there is a screening process. But just a couple last points on why mortgage pool funds have certain benefits is that you can add money to your investment. So if you start out small, say at the $50,000 minimum investment, you can add money over time. You can't do that on an individual note. The other thing you can do is if you don't need the income, and people who invest using their IRAs oftentimes don't want the distributions, you can have those distributions buy additional shares. So you can leave your money in the fund.
It's like reinvesting, like mutual funds that reinvest the dividends.
Exactly. So you really can't do that on an individual note unless you tell the borrower you don't have to make a payment. We can pay all the interest at the end, but usually you don't compound interest on an individual note. So again, so that's and you have an individual note, you get redeemed when the note gets paid off. So if it gets paid off early, you go back to cash. If he doesn't pay off and needs an extension, well, there's not a lot you can do other than decide to foreclose to compel that guy to pay you off if he doesn't have a way to do it. So in a fund, though, you can put in a redemption request, and when the funds are available, you can get paid off. So
what happened? If I remember correctly, there's a couple of extra additional benefits with the fund. Let's say if the borrower pays late, there's a late fee.
Absolutely. So the late fees, the fund earns the late fees. The fund earns extension fees. The fund earns origination points, and
Do they own 100? Do they get all of it, or do you share in that?
We share. It gets 100% of the extension fees. It gets 50% of the late fees. So there are a number of things that the fund benefits from when when the borrower neglects to pay on.
Okay, so an extension fee sounds like you made a 1-year loan, for example, and 12 months later, the borrower says, "Gee, I can't pay off the whole 100,000 I borrowed from you. Can we just extend the loan? And as long as I've been making my payments at 10%, will you continue to just don't underwrite me again? Just let me continue the loan at 10%."
Yeah, loan extensions are oftentimes not a problem because more often than not, my private lenders are aggravated by early payoffs. They would rather the guy just keep making the payments. So if the borrower's not in some form of distress, it's oftentimes a good thing. You write a 12-month loan, well, he decides, hey, I need another 6 months. Okay, fine. So we make a loan extension.
So it sounds like to me, because your loans are less than 70% loan to value, that the real risk is that we have a huge market crash in real estate from today, not going back 5 years ago, but loans you're making today would have to drop more than 30%. Does that sound about right?
That is absolutely correct. And I'm not one of those that believes that real estate only goes up. And in fact, I can foresee, a set of circumstances that might cause the real estate market to soften or dip a little bit in 2014, maybe 5, maybe even 10%. I'm not predicting that to happen, but if it happens, it would probably be from a combination of recessionary forces, mortgage rates climbing higher than expected, inflation rearing its ugly head again. Those are all or some unknown international event that causes oil to spike. I mean, there are a number of things that could happen that might.
How about a government shutdown?
So that's why we're not doing 100% financing. That's why we're not doing 80% financing. We're at 70. In fact, our mortgage pool fund has an weighted average loan to value today of 53%.
That's extremely low.
That is low. So,
very conservative.
So you would real estate would have to go down quite a bit. So we're solving for a correction in the market when we make our loans.
So again, because we have a very short time left, if people listening to the show right now, they'd like to earn over 8% on their money. How do they do it? Who do they call?
So they call us at Pacific Private Money. There is a short qualification process. It's not difficult. It's not lengthy, but you would call our office at 415-883-2150, or you go to our website at pacificprivatemoney.com because we've got a short investor qualification questionnaire you can fill out there. But certainly calling us or emailing us and asking for more information. But essentially, we don't take your money until we educate you about it, as you like to say, edumacate.
Yeah.
And again, there are certain disclosures we ask you to review and execute. So there is a process. Again, we're this is a regulated business. This is not a fly-by-night hard money predatory lending
nice.
goal.
That's definitely nice to know. And again, Mark's having an event on Wednesday, November 6th in Mill Valley at the Piatti Restaurant. There'll be some good free food and drink. And you can call 415-883-2150 to reserve your spot because it looks like it's going to be a, quote, sold-out event without there being sales. So
It'll be a shindig.
Okay, tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks again for listening. I'm your host, Edward Brown. And on behalf of Mortgage Investing 101, so long. We'll catch you next week.